Welcome to a new video of the series Swing Trading. What we will be doing today is performing a full breakdown on a pair as usual to understand what kind of swing trading opportunity we can be actually looking for on the pair. And to understand what kind of opportunity we can actually be looking on the pair, we have to analyze it both from a technical and in order flow perspective, and only by combining these two different types of analysis, we will be able to understand where is the next profitable opportunity on the pair. Now, if you're new to the channel, I'm a top author on the TRADINGVIEW platform, and every single day I share a lot of free analysis and education. So I really suggest that you do subscribe to the channel so you won't miss out on all this free education, and I will see you in the video. The pair that I want to speak about today is USD CHF because it is very near to providing to us a very good trading opportunity, and it is a very educational pair to speak about in order for me to explain to you guys some very important key lessons that you can apply immediately to your trading, and that will make you a better trader. So without further ado, let's get straight in the video. Now, starting from the monthly, the weekly, and the daily time frames, in which we will speak about the technical side of the market, we will then go and see what we have from an order flow perspective to see what hedge funds are currently doing in the market, and then we will go and see what kind of confirmations we can be looking for from a 4-hour perspective. So let's start our analysis from the monthly time frame. Now, on the monthly, what we can clearly see on the monthly, we can see that the market has provided a very strong impulse to the downside. Now, after an impulse, what do you expect? You expect the market to give you a retracement. Specifically, you want to see the market give you a retracement at least to the 0.382 of the Fibonacci taken on the monthly impulse. And this is a general rule. If you want informations on a retracement, you have to take your Fibonacci on the impulse before that retracement, which in this case gives us a first upside target at the 0.382, which is a level from which we can expect the market to find some resistance for a rejection to the downside. So from a monthly perspective, as we have just seen, we have two major things to take away. Number one, the market has a strong impulse and a strong correction, and the market is very near to the first resistance level after the impulse. Going down on the weekly, what do we see? So from a weekly perspective, we can see one major thing, that after this impulse, the market clearly has provided an inverted head and shoulders for the continuation to the upside and for the start of the monthly retracement. Now, why do I say clearly provided this inverted head and shoulders? I know that many of you probably don't see the inverted head and shoulders inside of this area. Well, an easy trick that you can use to identify patterns if your eyes are still not trained to see them when it comes to regular candlestick charts is going down on a line chart. On the line chart, you can clearly see that the market has provided this inverted head and shoulders, and maybe now that I go back on the candlestick chart, you will clearly see the pattern with a left shoulder here, a head here, and a right shoulder here, from which we definitely expected the market to give us this nice move to the upside, as it has obviously did. So on the weekly, we can see that the market printed a nice reversal, and we can expect even more continuation to the upside, because now all across this area we do have strong previous resistance, which is now turned support. So if the market will make it back to this area, from here we can expect more continuation to the upside, because we have the neckline of the weekly structure and pattern that we have already identified, which is an inverted head and shoulders. Going down on the daily, what do we see? Now, from a daily perspective, we can see two very important things. Number one, the market is currently overextended to the upside and in need of a retracement. In fact, after such a strong move to the upside, the market definitely needs a retracement before the continuation to the upside. And the second thing that we can see is that not only the market is overextended, but the market also created a bearish pattern from a daily perspective, and which is the bearish pattern that I am speaking about. The pattern that I am speaking about is an overextended W formation. In fact, we have down, up, down, and again up. Now, when you see something like this, okay, so the market making a move to the up, move to the downside, retracement, trying going lower, and then breaking to the upside, what do you expect? Is the market from this overextension to give you a move to the downside and go and complete the pattern at the previous resistance, which is now turned support. Now, if you're asking yourself, but why does the market create this pattern? Well, this is actually a very efficient pattern when it comes to manipulating the market, which is a pattern that hedge funds and market makers love. Now, how does this pattern actually work? Just a quick reminder, make sure you comment below and you let me know which pair or topic you would like me to cover or analyze in the next video. We have an impulse to the downside, followed by the retracement, and after an impulse and a retracement, most retail traders will start shorting, specifically retail traders that didn't look at the bigger picture. Because if you actually checked the monthly and weekly, it was pretty clear that we expected the market to create a move to the upside. But if you are only checking the daily, you will see an impulse, a correction, and after this rejection to the downside, everybody will start shorting, which is exactly what hedge funds need, because if they are shorting, if retail traders are shorting, they can buy because they obviously do the opposite. And remember that they have too much money to manage, so they have to generate the liquidity to actually fill in their position, which is the reason for which manipulations exist in the first place in the market. It's not because they want to rob your money, it is because they want to trade. And if they don't have the proper liquidity, they cannot trade. So what do? They manipulate the market and generate that liquidity, therefore bringing everybody in selling so that they can buy. Now, going back to our analysis, we know that we have an overextended W formation in an overextended market, and we are in need of a retracement. Now, if we want to measure this retracement, we have to take our Fibonacci from the low to the high of the impulse, which will give us a first downside target in between the 0.32 and 50% of this impulse to the upside. So we have a nice downside target at this level here, in between the 0.382 and 50% of the Fibonacci taken on this impulse, which is in perfect confluence with the start of this W formation, which, as we have just explained, is the first completion area of this pattern, from which we can then expect the continuation to the upside. Now, before I show you how we will be approaching this kind of situation with students, let's first go and give a quick check at what we have on USD CHF from a COT perspective, so commitment of traders, which is what hedge funds are currently doing in the market. Now, if you check the data for the CHF, you are actually already checking CHF USD. Why are we checking CHF USD if we check CHF? Because all currencies on the spot are traded against the USD. Therefore, if you're checking the data for the CHF, you are already checking CHF USD. And since we want informations on USD CHF, we simply have to reverse everything that we read here. So if we see here that clearly net positions are increasing, it means that hedge funds are shifting their positioning more to the long side of CHF USD, meaning that in reality, hedge funds are actually shifting their positioning to the short side of USD CHF. So we can definitely expect a move to the downside, considering that if we look here, we can see that with the last report, hedge funds have opened 3K long positions and closed 800 shorts. Meaning, if we reverse everything, that hedge funds have opened 3,000 shorts and closed 800 longs on USD CHF. So we can definitely expect this move to the downside, also from a COT perspective. So how we will be approaching this situation with students. Now, as usual, monthly, weekly, and daily are the best time frames when it comes to the direction of the market. But the best time frame for entry is the 4 hours, and obviously also the best time frame for confirmations. And if we go down on the 4 hours, what do we see? Now, from a 4-hour perspective, we can see that the market is absolutely not ready to create the move to the downside. In fact, we have a market that is still in a very strong bullish momentum, has also created now a nice M formation, so everything is still bullish. There is absolutely no confirmation for the short yet. However, things might change in the future, which is exactly what we will be waiting for with students. And always remember that the more the market will continue to the upside, the better it will be, because we will have a better risk to reward and better probabilities. when the move to the downside will actually start. So what we will be doing with students is monitoring price action from a 4-hour perspective, all inside of this area, waiting for the market to shift from a bullish market as it is right now to a bearish market, and only after the market will shift from a bullish to a bearish market. At that point, we will add USD CHF to our watch list, and as soon as the market will provide to us one of our valid entries, we will be taking a nice short with a very good risk to reward and very good probabilities for the move to the downside and for the market to actually complete this W formation at the first neckline of the overextended W formation, completing the pattern to the downside and giving to us a very nice risk to reward trade, minimum 1 to 3. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you. Also, make sure you go and check out the mentorship program. You find the link in the description. You first learn all the rules of my rule-based strategies in the program, and then you trade them live with me. Each and every day you get a new daily market breakdown showing you exactly how to apply the strategies with entry, stops, and take profits, as well as having me answering personally every question that you have every single day. So I really suggest you go and check out the program. The link is in the description, and I will see you in.